Hey guys, welcome back to another episode. In today's video, we will walk you through the most effective technique for combining multiple time frames to achieve a clear, structured, and well-informed chart analysis. By blending price action with smart money concepts, we will show you how to properly execute a top-down analysis to identify market direction, supply and demand zones, liquidity areas, and high-probability trading opportunities, moving from higher time frames down to the smallest details. So guys, if this is something that interests you, please hit the like button to show your support and subscribe if you're new to the channel. So what exactly is top-down analysis? Top-down analysis is a method that combines the study of multiple time frames and market elements to develop a complete understanding of current market conditions. By starting with higher time frames and gradually zooming into lower details, we gain a broad perspective of overall market direction and key price areas across all levels. But remember, if you begin from the monthly time frame and attempt to apply every single trading concept available, your chart will end up looking like this by the time you reach your entry time frame, which becomes completely ineffective. This video will teach you exactly what to focus on within each time frame, so you can perform a clean, logical, and well-structured analysis of any chart with ease. But first, why do we even need to combine multiple time frames? Well, here are the top 3 reasons. Number 1. Overcoming directional confusion. Here on the pound-dollar 5-minute chart, the market appears choppy, with no obvious direction. Price constantly violates structure levels to both the upside and downside, which creates confusion for traders attempting to identify trend direction. However, if we zoom out to the 1-hour time frame, we can instantly recognize the dominant trend and bearish pressure. This highlighted area is the same region we were previously observing on the 5-minute chart. So by understanding the higher time frame directional bias, we can confidently execute short entries on the 5-minute chart. Remember, whenever you feel uncertain about direction and the market continues to break important structure levels, it usually means you are focused on the wrong time frame. Analyzing the broader picture significantly improves your ability to take more accurate and confident entries. Number 2. Increasing accuracy. A small reaction at a higher time frame key level can translate into a major trend shift on lower time frames. That's why, before placing any trade, we should always evaluate how much space exists before price reaches a higher time frame supply or demand zone. This allows us to properly set profit targets, place logical stop losses, and reduce the chances of entering losing trades. Here on the Euro-Dollar 15-minute chart, we experienced a strong bullish move accompanied by a clear fair value gap between candle shadows. As a result, we had a valid order block, presenting an excellent long opportunity. However, price suddenly reversed direction and completely ignored that demand order block. And in case you're wondering why, here is the explanation. When we zoom out to the 1-hour time frame, we can clearly see that price had reached a higher time frame key level that previously acted as strong resistance multiple times. So, checking higher time frame levels helps us avoid unnecessary risk. On the other hand, take a look at this different example. Here on the 1-hour chart, we see a move with obvious inefficiency breaking above prior market structure. If price pulls back into the order block zone, it would present an ideal opportunity to enter long, place our stop below the swing low, and target the next structure level ahead. So now, let's check the higher time frame. On the 4-hour chart, we can observe that price recently broke above multiple supply areas. This shows that demand is currently in control, and we still have enough room before reaching the next unmitigated supply zone. This creates an ideal trade setup by combining higher time frame structure and directional bias with a lower time frame entry model. Number 3. Optimizing trade entries. Analyzing multiple time frames allows traders to pinpoint optimal entry and exit levels. For example, if you are waiting for price to pull back into an order flow area and plan to enter by positions during bullish momentum, setting entries at the top of the zone would result in unnecessarily large stop losses. Instead, a better approach is to seek confirmation and execute trades on lower time frames. This improves entry precision, minimizes false signals, and boosts overall trading confidence. Now that we understand the importance of multi-time frame analysis, let me show you the best technique to combine multiple time frames for a clear and effective chart analysis. But before we continue, if you've enjoyed the video so far, please smash the like button and drop a comment below if you have any questions. Now let's walk through our top-down analysis process step by step, starting from higher time frames and scaling down to uncover precise trading opportunities. We use 3 categories of time frames during our analysis. First, we use the weekly and daily charts solely to identify major market structure levels. Second, we rely on the 4-hour and 1-hour charts for most of the analysis, including identifying market direction, supply and demand zones, order blocks, liquidity areas, and trade setups. Third, we utilize the 15-minute and 5-minute charts to seek confirmations and refined entries when necessary. Now, let's apply this approach to real market examples to fully understand how it works. Here we have Euro-Dollar on the weekly chart. First, we mark the most recent key market structure levels where price has reacted. We intentionally keep the chart simple and only highlight the most relevant zones near current price. For example, this level marks a historical high that recently rejected price twice. Here is another key support level, which has been respected multiple times. We can also draw another structure level here. This completes everything we need from the weekly chart, just high probability structure zones where price may react again. Now, let's zoom into the daily chart. On the daily time frame, first, we adjust the weekly levels to capture the maximum number of touches. Next, we add daily structure levels using a different color so we can easily distinguish them when zooming into lower time frames. Always remember, higher time frame levels carry greater importance. At this stage, our daily analysis is complete. However, there are 3 critical rules to follow when drawing structure levels. First, draw levels where price has reacted multiple times. Second, prioritize candle bodies rather than wicks. Third, treat levels as zones rather than thin lines. Additionally, there are 5 criteria that make structure levels more powerful. Number 1, turning points. These are zones where the market reversed previously. Number 2, multiple rejections. Repeated reactions strengthen a level. Number 3, acting as both support and resistance. This increases reliability. Number 4, strong moves away from the area. Sharp reactions indicate importance. Number 5, recent structure levels. Fresh zones tend to be more effective. Now, let's move to the 4-hour time frame, where smart money concepts come fully into play. On the 4-hour chart, both weekly and daily levels are visible, and these serve as major reaction zones. We use them in 2 primary ways. First, a break above or below these levels helps determine directional control. Second, they serve as higher time frame targets. Now we apply smart money concepts, identifying market direction, supply and demand zones, order blocks, fair value gaps, liquidity pools, and trade setups. Here, price has broken below a key daily level with momentum, indicating bearish control. We also observe inefficiency and a break of structure, which defines our order block zone. However, since price has just rejected a major daily level, we avoid blind sell entries and instead wait for lower time frame confirmation. If price breaks above both higher time frame levels, bullish momentum would dominate and target the next weekly resistance. Now let's analyze the 1-hour chart. We continue applying smart money concepts, using our 4-hour bias as directional guidance. Price is currently forming liquidity before reaching the 4-hour order block, reinforcing our bearish expectation. Ideally, we want the 1-hour structure to align bearish with the 4-hour chart. Now let's move to the 15-minute chart for final confirmation. At this stage, we wait for price to enter the order block and form a change of character. If no change of character appears, no trade is taken. Our first target is the daily level, and if broken, we aim for the next weekly structure zone. This setup is simply an example of trade execution using top-down analysis. Before risking real capital, every strategy must be backtested to ensure consistent performance and proper risk management. Now let's apply this framework to another pair, the Aussie dollar. On the weekly chart, we draw only the most relevant structure zones. Then, on the daily chart, we refine those zones and add new daily levels if necessary. On the 4-hour chart, we identify bearish bias following a deep retracement into an order block. 2 scenarios arise. If lower time frames show bearish confirmation, we enter short targeting daily and weekly zones. If price breaks above the order block, bullish bias takes control and targets higher levels. Zooming into the 1-hour chart, we identify a change of character after mitigation, presenting a high probability short setup. Our targets align with daily and weekly structure. There is no need for lower time frame confirmation unless additional trade opportunities are desired. But remember, more trades do not equal more profit. So guys, I truly hope this video provided value. If it did, please hit the like button, subscribe if you're new, and drop your questions in the comments below. Thanks for watching, and I'll see you in the next episode.